and others speak. And I think there are some very important aspects that came out of, from MDB's financial institutions perspective. And this next round of the panel discussion seems to be, it's like ignited the discussion that we are going to do. So let me move on. We have 2 rounds of questions for each of the panelists, and I would request, given the paucity of time, if you could just limit your interventions to 2 to 3 minutes as requested earlier, so that we could also take some audience questions. So let me pose my first question to Alessandra. Alessandra, my question to you is that, EU level policies and negotiations were ahead of the world so far, if I may say that, because EU taxonomy came out well in advance, and there's so much work that EU has been doing around policies, climate finance, and the fact that most of the climate finance has also been originated from EU states. What are some of the outcomes or results that EU funding agencies are focusing on from the potential adaptation finance projects that would be there in the pipeline? Over to you, Alessandra.
Thank you very much, Namita, and good day to all of the participants and fellow speakers and panelists. Let me, of course, start by thanking the organizers for this event and for inviting us to be part of these discussions that is indeed very timely. Namita, as you mentioned, the EU remains, with our member states and the EIB, the largest contributor to international climate finance. I think we are around 23 billion in 2021, as well as 2020, and the figure for 2022 preliminarily indicate we are in the same ballpark range. They will come out later this year. Nearly half of it does contribute to climate change adaptation, whether it is targeting directly adaptation or as a cross-cutting issue. Now, of course, this is no reason to be complacent. It's quite clear, and we recognize it very much, that globally we do not see sufficient finance flowing to climate action in general and climate change adaptation in particular. Not only it's not enough to help us address the challenges intrinsic in climate, but also it's nowhere near enabling us to ripe the opportunities that many partners have around the globe in the transition itself. I think there have been, speakers before me have mentioned quite a few of the challenges and opportunities in financing adaptation broadly, and then for agriculture and the food systems. I'd like to add just a couple of thoughts to that discussion before I turn it to the more practical question that you asked me, with your permission, if I may. So, of course, from where we sit, it is quite clear that in discussing with partners, whether it is private sector, banks, multilateral institutions, CSOs, governments, and also communities, we do see that there is significant capital out there, yet the very bulk of it is either hard to access or not really flowing in the right direction, if I may. So actually the wrong direction. I think in New York, several leaders have called for, relooking at finance that is flowing to fossil fuels still. So that is certainly a matter of urgency for us, making sure that we use our policies power, but also our resources in the public sphere to leverage as much as possible international and domestic capital for climate action, and drive it in particular where the flow is more difficult to get to, whether it is frontier markets or vulnerable communities where there is very high risks for private sector in particular to engage. I mentioned the opportunities before, and I do believe that there is a significant change in the global narrative and the regional narrative. I mean, I think in Paris at the Summit on the Global Finance Impact, we do have progressed quite a lot around really tough discussions on debt restructuring, reforming the global and domestic financial architecture, and looking at creating fiscal space for vulnerable countries. The recently concluded Africa Climate Summit, for me, marked a really fundamental change. We have seen African leaders come out very strongly on the need for Africa to grow differently and offering, the very rich natural resources Africa has, the huge renewable energy potential, but also the young and innovative workforce as a solution to the global challenge of climate action. And I think, resilient food systems and agriculture clearly fall squarely within the vision of a different development pathway and opportunities that businesses, communities can really ripe. To us, it's clear that shifting the capital that we need to climate change adaptation, whether it is for agriculture or more broadly, really has to be driven by political vision and by policies. And we need to put in place the very right incentives at all the different levels to ensure at the end of the day that all finance flows are aligned and contribute to the objectives of the Paris Agreement. And that's very much what the European Green Deal is all about. It's making sure that we approach this issue as a whole of economy, whole of government problem or opportunity, where we bring together domestic and international policies, but also, of course, different sectoral policies, whether it is energy security, nature, biodiversity, and of course, agriculture and food systems. Increasingly, we also see peace and security and defense taking central stage. And of course, food security is yet another dimension that remains critical in what we do. So with this very broad introduction and reflecting some of the discussions before, let me now come to what we see as an important element to translate, if you wish, this vision of a policy-driven change into reality. We're really looking for interventions that have a potential to be transformative, that are really reaching individuals and targeting specific livelihood opportunities and ecosystem services. The ultimate objective at the end of the day is to improve the life of communities while at the same time helping address global challenges, whether it is biodiversity or climate action in particular. That's why we work very much directly with our partners at the national, regional, and sometimes subnational level to identify very broad priority areas of intervention that address development concerns, but are in line with the objectives of the Paris Agreement, and they could mean biodiversity outcomes. And we identify areas that are of mutual interest. And then we work with partners to really detail and translate these broad policy priorities into concrete projects and programs that are then implemented either directly by our partner governments or by member state agencies, international organizations, IFIs, or other service providers. So the very first step is really to have a strategic dialogue that brings together all the stakeholders, smallholder farmers, private investors, civil society, governments, to really look and identify what are the risks associated to climate and economic change, what are the options for adaptation and the development of the agricultural sector, what is it that we want to achieve in terms of desirable outcomes for livelihood improvements, and what is feasible. So for instance, how can we close nutritional gap for better health and more diversity, working both on agriculture and on education, for instance. And we look at ways of bringing together the different tools we have at our disposal for impact. So we merge, if you wish, or we use the traditional grants together with innovative tools to de-risk investments, direct this financial flow to frontier markets through, for instance, the European Fund for Sustainable Development plus open access guarantees, or the Global Green Bond Initiative that the EU and the EIB launched recently in Paris, which really aims to mobilize up to 20 billion of sustainable investments across the globe with an initial commitment of 1 billion. And it is very much one of the points and the lessons, if you wish, that Franziska mentioned before. We need to leverage different instruments so that we can reach impact. And we bring together EU member states and their agencies in a team Euro spirit, once again, to reach scale and impact, because that's where we are. You have said it before, we do have solutions that now need to be scaled up, and for that we need to bring together the different tools and stakeholders we have. Now, we're looking very much for initiatives that can help us reach more than one objective at the same time. If you wish, saving more than one bird with one coin, as I like to say. And agriculture and land management, of course, have a huge potential to do that, reducing risks through mitigation and adaptation, all the while generating food security and income for people and promoting inclusions. And so this is one of the critical criteria for us, making sure we focus our resources where we can achieve more than one of the objectives. So, we're talking about land degradation, for instance. If we invest in green infrastructure, in landscape or different parcel size adapted to wind and water erosion, then we can enhance productivity, increasing food security, but also enhance resilience, and why not reduce emissions of greenhouse gases by the sector, because we shouldn't forget that agriculture has a huge potential to contribute to mitigation as well. So finally, it's not just about the amount of financial resources that are allocated to the sector. We need to be able to measure the impact, and that's one of the most challenging aspects that we face, in particular at the more comprehensive level. So that's why we're trying to support the use, if you wish, of a global Europe result framework, so that we can have across the different investments and grants that we have the same common set of indicators that can help us better understand, for instance, at the global level, again, what the impact of EU interventions are. There are quite a few that are related to agriculture, including, sustainable management practices for pastoral ecosystem and agricultural land. I will, of course, not go through all of these, but again, to emphasize that measuring the impact beyond the project level is fundamental for us to understand where, how we can better target the limited financial resources that we have to achieve the higher impacts. So thank you very much, Namita. I'll stop here for now.
Thank you. Thank you very much for those interventions. I think, you very rightly brought out that there are transformative opportunities that large institutions are looking at, because ultimately it is about multiplying also at the impact level. And that really brings me to my next question with Anil. Anil, and it really flows through from what Alessandra had just mentioned. So, institutionalization of the demand side is very critical to scale financing, because what we are hearing is that in pockets there's work being done, but we really need the scalability and the transformation. And, we have seen within microfinance, we've seen within FPOs in agriculture, SHG settings that have been, the structures have worked. Now, would it be practical to create a separate institutionalized structure to fund, say, adaptation for farm communities, like adaptation collective groups, for example? Or do you think because there's an existing framework or a structure that's already available, it's better to penetrate through that and look at how we can enhance financing? So over to you, Anil.
Thanks, Namita. This is a very, very interesting topic that I don't know much about and have been learning thanks to the erudite speakers and the panel members here. And good to see Ravi also. We were together in Chennai in an RBI event very recently. The idea of a newer vehicle is very, very interesting. And I must compliment that, thanks to the panel discussion, that you triggered the thought process of having a new collective. But I'm a practitioner, I'm a person from the ground, and I would like to bring the perspective of a practitioner on the ground where the rubber meets the road. And I would say that the challenge of making or achieving the objective of what we have set out to in this, on this topic, is both supply side and demand side. It's just not the demand side alone that needs a newer vehicle, because we are on the or at the cusp of both the supply side and demand side. Supply side being the wholesale that we need to borrow, and the demand side where we need to deploy the resources to be able to make these financing products be deployed on the ground. So for the benefit of audience, Sammunati is an entity that works in the agri value chains with a vision to make markets work for smallholder farmers. And we are solving for the dimension of access to finance and access to markets, in addition to the advisory and the technology that we bring in. So in my view, while I put the FPO at one end and put the multilateral entities that we have the benefit of discussing on some of the programs, there are three dimensions that become relevant on both sides, irrespective of whether it is institution side or demand side. Whether it is supply side or demand side. One is awareness, right? Awareness about both the sources and their respective users, right? So what are these specific sources and how do we go about using them, and matching the sources to users in a transparent manner is very, very important. And do I have the awareness to do that? I may have the ability to do it, but do I have the awareness to do it, is one dimension. The second dimension is accessibility. Now that we also are working with you in bringing this awareness, and you have been doing a lot of handholding of Samunati in making sure that we understand this space better and don't look at it from a debit credit dimension, but look at it from a larger scope. What do we do with the awareness if we don't have the accessibility to this? It's like telling someone you need to shed 15 kilos. What do I do about it after that? Awareness is only one part of it. The third one is, why should I do it? Why should I go about doing it? That takes me to the third one, which is alignment of incentives. Are the incentives aligned on both the supply side and demand side, so that entities like ourselves who are at the cusp of making the demand reach the supply and making the supply access the demand, how do we align the incentives? And in all the speakers, there is there are streaks of these three dimensions, awareness, accessibility, and alignment of incentives coming in various forms and shapes. Anna spoke about there is no magical bullet, and do we look at access to finance or models of financing? That for me are two sides of the same coin, and how do we fit in within the dimension of one of these three A's, the triple A's that I have understood from this topic. And I am a firm believer in using the startup energy to be solving some of these problems. And I couldn't agree more with Sandeep when he said there are interesting interventions that are coming from startups, and we at Samunati have a dedicated platform for the startup engagement. And the dimension of solving the problems that we are looking at from first principles can happen if we don't chisel or modify the existing wood, but take a new wood and chisel it nicely to see what we need. And our endeavor would be ACG, or the collective group or adaptation collective group, is a very, very interesting thought, and I'm definitely gonna understand more about it. It is already 2-3 notches ahead of what we need today. Today, what we need is the dimension of understanding the supply side and demand side from these three A's perspective, bringing awareness about what are the dynamics of the supply side and demand side. Second one, after making them aware, bringing the dimension of the accessibility on both sides, so that there is a seamless flow of money on both sides, the ones who want to give and the ones who want to deploy, and how do we go about it? And that can happen only if you align the incentives. If there is no alignment of incentives, it's not going to happen. So this is the point that I wanted to make, given that we have a limited time. Thank you.
Thank you, Anil. I think that's a very valid point. And, I think overall how you bring this whole thing about is based on these three stacks that you really mentioned about awareness, accessibility, and alignment. I think that leads me very well again into the question that I'm going to make to Ravi. So Ravi, when we talk about building resilience amongst farm communities, it entails either interventions through activities on the farm itself, or it could be outside of the farm. So based on your experiences with farm communities, what measures do you think are the most impactful, faster to scale, less prone to investment risks, interventions that are made on the field or outside, but really keeping in mind the impact and the scale and the time, of course. Over to you, Ravi.
Thanks, Namita, and thanks for inviting me to this fascinating conversation. Already my horizons have been expanded, and it's always a pleasure to follow Anil on a panel. I'm going to answer your question in a slightly different way, because I think it's both, but it's both from the perspective of looking at systems. I think Alessandra alluded to a whole of government, which I would say a whole of system approach, because you can't play one off against the others. Smallholder farmers are not just on their farms; they're also off their farms, and so one approach, and I can cite others from other countries, but one approach that is working quite well, in my perspective, is integration of diversity into systems, because resilience comes from that. Has been, for instance, India, the national agroforestry policy, which debottlenecked a whole lot of attitudes and investments towards trees and opened up scope. So this was something that worked both on farm and off farm, but it worked from a systemic perspective. So when we start looking at adaptation, and I'm not a finance person, I think the key word right now is, what are we trying to adapt to? And really, I think that we're being led up the garden path if we think adaptation is that there is a new circumstance that we need to adapt to. I think what we need to think about is resilience, because the circumstances are going to keep changing. We're going to keep having shocks. The question is, how quickly can smallholder farmers at landscape level, so not just the farmer, but the social capital that they have with other farmers and along value chains, how soon can they stand up again? And so when you start looking at this and you look at it from a adaptation or resilience finance perspective, inevitably, and this was alluded to by a number of people, you're looking at the issue of risk, because the people who have the money are not coming out and giving the money to those who need the money, because they don't know how to handle risk. And so de-risking this entire thing is, I think Dr. Kader spoke quite eloquently about this, is a critical challenge we have if we want to move forward. And I really welcome Franziska's interventions about the green list and the tools that they're using to help to de-risk. What we try and do is de-risk using science, because we don't have the financial resources. But there are other tools that you can use to de-risk. The other point I want to make along with risk is that if you want to work at scale, you have to work at scale. Do not think that you could start at one scale and pilot out, because that's not going to work. So we have to start working at scale. And when we look at finance at scale, the ones who are sitting on it are the private sector. So putting all of these things together in the interest of trying to understand how do we lift smallholder livelihoods and the environments up together, we are trying to use science to de-risk private sector investments. And one of the tools that we're using for this is an initiative that we're starting with the government of Luxembourg to start an entity together that would allow us to create a boundary spanning organization that channels private sector investments into more resilient outcomes that work for equitable benefits to smallholder farmers, while at the same time creating a much more a system that builds in diversity much more than at present. Because when we look at agriculture and you're looking at monocrop agriculture around the world, you are not building resilience into those systems. You're assuming that there is a financial cushion that they can fall back on, and if they're large enough, they can do that. But everything else is not about resilience. And if we look at examples from Andhra Pradesh, which is a state affected repeatedly by cyclones, and the natural farming examples that we are seeing over there, those systems tend to be much more resilient. So over time, they tend to be more productive as well. So we need a mind shift in the way we conceptualize our systems, de-risk investment into it, prime the pump with transitional investments. And again, I was very impressed with the presentation by Dr. Kader and what Egypt has been thinking about. I think a lot more need to follow on this. We are working, for instance, in India with NABARD at the moment to create the kinds of models that are missing so that investments can go into farmers who want to plant different kinds of trees than eucalyptus to open up new value chains and commodity chains. So when we start looking at the whole thing together, we're looking at aligning adaptation finance to incentives that Anil was speaking about that take into account the need for resilience, for scale, and with a new set of tools that actually look at a new paradigm, which a paradigm that we are starting to call a stewardship economy, rather than simply assuming that markets are going to fix everything. Markets cannot, they have limitations. We need to think beyond markets, and the role of governments here is critical. And this comes back to the point that Alessandra was making about a lot of what the European Union is trying to do, and other governments are trying to do, the Indian government, the National Agroforestry Policy, and some of the new initiatives as well. And I can speak to examples from Peru, from Africa, etc. I think we need to reimagine the role of governments in all of this, because markets on their own are not going to solve this problem. Namita, it's all of the above and then some.
Thank you very much. Reimagining not just the role of the government, but I think there's a movement to reimagine or remodel MDBs, and more and more that's coming out in terms of what kind of incentives and risk covers that we really require to draw in more of private capital. And therefore, my question to you, Ben, who's representing the Green Climate Fund, building the resilience and adaptive capacity of indigenous populations depend on agri or forestry outputs, and that is a very important other landscape to look at. So from your experiences with GCF, where adaptation interventions would be impactful for indigenous communities, at the same time, how were bankabilities built in? Because I think that is one of the biggest questions, and incentivizing commercial finances to come in. So some of your thoughts on that, please. Over to you, Ben.
Yeah, thanks, Namita. Thanks for the great question. And this is particularly relevant for the GCF, where we are the largest public sector fund which has mandate for both mitigation and adaptation finance to climate change. In the AFLU sector, particularly with respect to forest sector value chains, this is where the greatest potential lies for indigenous peoples and benefits for their adaptation, their resilience. A well-designed project in the forestry sector should always be cross-cutting, should always deliver both mitigation and adaptation benefits with respect to climate change. If it doesn't, then there's something wrong with the design. And this involves going beyond the Cancun safeguards, which were elaborated with respect to REDD+ back in 2010, and towards the delivery of environmental, social, and economic benefits, additional to the climate change benefits. Now, in terms of adaptation, any project in the forest land use sector must be based on ecosystem-based adaptation rationale, based on the provisional maintenance of ecosystem services. But in order to incentivize commercial finance, it must also involve commercial products or commercial forest product value chains. And so the answer to your question is that it lies at the intersection of livelihood-based adaptation of forest-dependent communities, including indigenous peoples, with ecosystem-based adaptation and mitigation impacts of forestry initiatives. So this is where we end up really looking at sustainable production, so reduce the impact or zero deforestation impact of land-intensive commodities, particularly those where there's a high degree of involvement of smallholders and indigenous peoples, such as high-value non-timber forest products, or particularly the value chains that fall now under the EU deforestation regulations, such as coffee, cocoa, and oil palm. So interestingly, earlier this year in June, a workshop organized by FAO and CIFOR-ICRAF on the sidelines of SBSTA, called Forest and Trees for Adaptation, underlined the significance of national REDD+ strategies for helping governments to identify adaptation benefits from forestry initiatives. Though those strategies, of course, are developed with mitigation impacts in mind, they serve as a particularly useful framework on which to identify where adaptation benefits, particularly for indigenous peoples, can be delivered. Peru, Ghana, and Cambodia all refer to this. So it's a global. It is not limited to one part of the South, but it goes across these continents. In terms of the GCF projects, our experience, I can refer to a project in Ecuador, which is explicitly based on the implementation of a national REDD+ strategy, where experience with coffee value chains and indigenous people's involvement in these value chains resulted in a partnership with Lavazza, where they committed to a 33% increase in the price paid for produce from these communities compared with the base price. We have other projects working with cocoa and shea butter in West Africa, also grant finance projects supporting national REDD+ implementation strategies, and in Laos with GIZ support, we're also looking at the development of private sector-led initiatives in the REDD+ implementation project there. So there's a lot that we can build on the with respect to the great advances made internationally on the forestry mitigation agenda, and adapt that and use as a basis for identifying adaptation initiatives. And the next step really for us in GCF is to look explicitly at ways in which we can move on from these early grant-based projects to ones where we have more complex financial structures with equity and subordinate loan investments from the GCF side, particularly looking at the Amazon Bioeconomy Fund and the Agri Fund, which were approved by our board over the last couple of years. Both of these are initiatives that don't depend just on GCF finance, but the role of GCF finance is, as other speakers have mentioned, is the de-risking of these investments, and particularly in investments in small-scale zero deforestation or reduced deforestation initiatives, where in markets where other investors are not yet ready to go. And we're particularly keen on working with local financial providers so that they can differentiate biobusinesses, they can understand what we mean by a biobusiness, and offer preferential services to smallholders and producer associations in these countries. So that's what I have for you there.
Yeah, great. Thank you very much. I think there are a lot of learnings here in terms of how GCF has been able to create that multiplier in drawing in projects and commercial capital. So thanks for that, and I'll come back to you shortly. Let me move over to Kristina. Kristina, WWF has been at the center of many of these activities that are happening, and it would be interesting to know how the particularly WWF Singapore's Asia Sustainable Finance Initiative, which is looking to integrate adaptation in 6 of its activities, that is standards, industry engagement, finance solutions, regulations, capacity building, and research. How is that working? And please share some thoughts on, because there are multiple aspects of awareness that came out, alignment that came out, and it's important to know what's happening under this initiative. Over to you, Kristina.
Great. Thank you very much, Namita. And yeah, pleasure to be here, and thank you for making WWF a part of it. So I think the Asia Sustainable Finance Initiative, first of all, is a multi-stakeholder platform where we try to bring together, on the one side, other fellow partners in the face of science-based organizations who bring in knowledge and resources. And we try to align all of this, including collective engagement across the region. And then we have kind of our steering committee that really grounds the practicality of the mission and the implementation of a lot of these resources in the face of the steering committee, which is the capital markets associations. And then we have obviously the main stakeholder that kind of we bring this to, which are the financial institutions, the corporate banks, private banks, as well as asset managers. So the strategy around these 6 pillars that you mentioned is very much aligned with how WWF looks at moving sustainable finance. Now, adaptation can be kind of one, or adaptation, driving adaptation finance can be looked at one element within that realm of how we kind of tackle things. And we divide it into kind of 2 streams. The way we tackle this is through the lens of greening finance and financing green. So when we speak of greening finance, it's really your ESG implementation into decision-making from the very high policy level to, down to the portfolio level and across your organization, across your people, your processes, and so on. And why that's important and how that obviously ties to adaptation financing or any type of green financing for that matter is we spoke also about the various barriers. You yourself, spoke about this, how sometimes, and I think KFW spoke of Franziska to this, that they also play a role in enabling various financial institutions to transition. And why that's important, because especially some of the European DFIs, as well as others, they need a certain level of transparency and disclosures to be able to provide that financing. So that's very important to kind of start to lower from a policy level those barriers. Then also part of that greening finance is harmful subsidies, because to speak to agricultural, for example, I think a recent World Bank report states that in agriculture in particular, on an annual basis, more than 600 billion of direct subsidies actually are driving the excessive use of fertilizers and other chemicals which are degrading soils and which are obviously also harmfully impacting livelihoods and human health. So I think just realizing and looking at subsidies and kind of lowering harmful subsidies and increasing subsidies for sustainable agriculture is an important element that we look at. And then taxonomies and, central banking discussions. And just one thing I will mention on regulation, of course, we work on the risk element, but what we work on as well is encouraging around the discussion of the global biodiversity framework and biodiversity generally, as a financial system risk, making them look at it not only from the risk perspective, but from a requirement of private finance to actually start to allocate capital for adaptation and for various other green types of financing. So that's kind of the umbrella of green financing and why that's and how that's relevant and important for adaptation. But where kind of the rubber really hits the road is financing green. And these are all of your green financial solutions, whether they're innovative, whether they're products that already exist. But maybe relevant here is to say something that we're trying to scale is we look at nature-based solutions, obviously, but what we are focusing more on developing here in Asia is the so-called bankable nature solutions model. Now, what do I mean by this? Imagine an NBS, how we define, right? There are many definitions of BNS, but we look at it as a nature-based solution. So you need to have the triple bottom line, but you need to be creating positive environmental returns that lead to positive biodiversity impacts and obviously climate mitigation and adaptation benefits. You need to have things that are, factors that are acceptable to investors. So you need to have a cash flow generating model or activities. You need to have sufficient collateral. You need to have high probability of success within your project, a clear exit strategy, as well as obviously an acceptable risk-adjusted return for your investors and a clear proof of concept. So that's what we look at when we say bankable nature solutions. And there are various blueprints that exist, right? And here is kind of the magic in this, because especially now with blended finance being discussed in this de-risking and the public-private plus philanthropic partnerships that are now becoming more and more talked about and more partners are entering into looking at credible models, we see that for BNS, there are many different blueprints that exist. So obviously you can have your blended finance where you have as a model your public finance and your private finance institutions, and then your bankable project. So your public finance, that can come in the form of grant. It can come in the form of, filling a viability gap before your private finance can come in. It can be in the form of many other things. And also we're seeing more and more models where you have that blended finance model, plus things like, you know, a carbon project or a biodiversity kind of gains income stream plugged into that blueprint as well. And there are many successful projects that we have throughout the global south, all in the area of agriculture for now predominantly. But I think the important thing to mention there is when we look at KPIs, it's obviously things that are again bankable, plus the social element in terms of how many people have been trained and equipped on sustainable finance or sustainable agriculture practices, how many new jobs has this model created, how much has the income of the people on the ground been increased, etc. So these are obviously important elements to bake into that blueprint and that bankability model. And last but not least, something that kind of underpins all of this is the capacity building. And I think a lot of the other panelists spoke to this, because we need the capacity across the stakeholders. And something we're seeing more and more is we cannot speak about sustainable finance at an ESG level anymore. We really need to start looking at it at the sector by sector level, right? Because, you know, when we even speaking about climate mitigation a little bit, when a financial institution sets net zero targets and climate targets, it does that on a per sector, a subsector level. So when we look at, you know, adaptation and all of these elements, we need to, and capacity building, we need to look at it at a sector level and go deep. And that means cut across all of the different stakeholders and have an inclusive model for capacity building. So financial institution looking at their corporates and how do they equip their clients with knowledge, looking at the SMEs and really looking on people on the ground, because without the field level buy-in and the community's buy-in, in the long run, these models will never and projects will never be sustainable. So that needs to again be a very holistic model. So yeah, perhaps I'll stop there.
Thank you. I think holistic models and you know, how do you take into account triple bottom line, risk-adjusted returns? I think these are going to make more and more bankable projects. And I like the way you spoke about a very comprehensive framework. I wish we have more time to discuss all this, but I'll come back to you. Let me go to Ajith now. Ajith, you are handling a very important topic, and it is said that the next World War III may be triggered by water, right? So in order to ensure access to water despite climate-related changes, what are the approaches that FIs, financial institutions, need to take to increase financing to the water sector? Over to you, Ajith.
Thank you, Namita. And thanks to all the panelists and keynote speakers. I think it was in laying out what the agenda of the world should be in terms of how we work together, and also what priorities we need to set as we go forward. And let me also not take a doomsday scenario. Let's probably take a positive scenario and see like how best can we cooperate to avoid a third world war out there. So I think in this context, Namita, when we look at water, and particularly when WRG is involved in these conversations, drive multi-stakeholder platforms and partnerships. So we've been doing that for the past 15 years now, working with the client governments, with private sector, and also with various civil society and academia institutions and representatives from that side as well. So while we all understand that water is a matter of concern, when also scarcity, it also presents an opportunity for looking at different elements of both adaptation and mitigation. Now, from the classic water resource management, supply demand side issues, to transitioning into climate water nexus issues, we have kind of also looked at three major points that all the speakers today actually came towards too. So which is understanding what kind of new approaches can we follow, new strategies can be adopted, what new tools and financial models or cater and include the priorities of the new set of stakeholders out there. And it needs to be an inclusive policy to be practical. Now, looking at that perspective, I think we see a new kind of approach, at least from the progressive governments with whom we are working, to include adaptation and mitigation in their outcomes in their financing as well. Now, there are conversations with which client governments drive to include co-benefits of climate change. And most of the governments would now want to also look at how classic plain vanilla water resource investments can be now also be converted to climate adaptation and climate mitigation programs. So a classic example that we have here again is from Uttar Pradesh in India, where we are working with the state government on an agriculture transformation project in which water is the main there is to, by bringing in climate smart water management, you're also trying to bring in more of climate outcomes. Say in the case of UP, Uttar Pradesh, we have close to 11 million hectares under paddy. And in these rice grown areas, if you are doing smart water management, then you're also leading to less emissions of methane. So the government is now looking at programs which include goals from both adaptation, mitigation, and water management, leading to multiple benefits that can be accrued to the community. And in that process, there is also openness to consider new institutional frameworks, such as special purpose vehicles. So the government itself has floated a special purpose vehicle that could now transform the Agri water agenda by incorporating the climate outcomes. Here, I think, again, if you take this perspective that all other speakers actually took today, which is about looking at these new institutional frameworks, then this is also a point where we can look at new financing products, because governments are now open to combining, to also looking at blended financing products that can help SPVs to achieve these multiple co-benefits. So I guess when we are looking at institutions, and as one of the speakers rightly mentioned, we would also need to look at the capacity of governance and the quality of governance that can actually differ with regard to subnational and national levels to achieving some of these outcomes. And that is very critical, because we speak about PPPs as a panacea when it comes to most of the problems that we have in public sector. Now, PPPs in water have been the most difficult hurdle to tackle, because we see a high rate of failure when it comes to PPPs. And one of the major reasons that we often find when it comes to PPP failures in agriculture and water is the low quality of governance and the low quality of institutions that actually are managing this. In one of the programs that we actually were part of, we also had a very innovative financing tool, a hybrid annuity model for irrigation. And in fact, the quality of the transaction was determined by the quality of governance institutions that were at the lowest level. So water user associations, if it's not functional, if it is dysfunctional, or if the quality of governance is not up to the mark, then the transaction cost goes up for the private sector parties, the service delivery mechanisms fail, and then the PPPs are destined to fail anyways. So I think in all these cases, the quality of governance, and again, as rightly as Anil mentioned before as well, the capacity and the awareness that needs to be factored in would also need to be kind of part of all the interventions that we are targeting here. I think what the World Bank is looking at is in the next decade or so, if you're looking at meeting the SDG goals itself, I think there would be a financing gap of upwards about 1.7 trillion. And this is not to be met by MDBs or FIs alone. I think just last year alone, the World Bank's water portfolio could finance only 6 billion. And so if you're looking at the financing gap that's to be kind of addressed in such a scenario, we would need to have private capital mobilized. We would need to have blended financing approaches to be adopted. We would also need to look at new financing partners and new stakeholders, including startups, as Sandeep mentioned. I think this would be, I would say, the ingredients that would determine how we effectively address conflicts and also move towards more of cooperation and partnerships in this space. Over to you, Namita.
Thank you. Thank you very much, Ajith. And thanks for bringing out not just what's gone right, but I think what's gone wrong. There's a big learning from the failure of certain models. And thanks for bringing that out. I think that's very important insight. And, I see 4 questions in the chat boxes, and I would like to take the audience questions because I'm also keeping an eye on the time. So there's an interesting question here that we've got, which says that we are operating microfinance bank called Alpha Maga Microfinance Services Limited, which is a community microfinance in Ghana, Ada Ghana. We are the agricultural locations, and 85% of our clients are into agricultural businesses. How can we partner your establishment to achieve your vision by elevating our agricultural clients from low level to high level? So that's one of the questions, and maybe I could go to Ben. Ben, would you like to, from a GCF standpoint, answer that question?
Well, thank you, Namita, and thanks for the question. Yeah, it's a tricky one. When we're talking about small and medium enterprises, I mean, GCF is a funding body that generally is quite large scale, and we work on behalf of, well, our clients are UN member states ultimately. We work on channeling funds to projects which are brought to us by member states in association with accredited entities. So for a particular group of small and medium enterprises or a producers association, it's difficult from our perspective to finance at that kind of scale. So I think it was Ravi that mentioned earlier that we need really to look at the government interventions, and in order for us to develop effective financing mechanisms for adaptation, the way to do that, the best approach is to use the limited finance that we have in the most effective way, is to work on policies, on governance, on certification systems and standards and capacities. And this is the kind of program that we look to receive from our accredited entities and the countries that we support. So through those channels, more at the national scale or jurisdictional scale, we hope to be able to reach these associations. I think, if I understand where the question is coming from, in the most effective way. As I mentioned earlier, the examples that we have from some from Ecuador, we do have a project in Ghana that sprang to mind, working with small scale producers in shea butter and shea butter products. So it is a conundrum. We can't work directly with these small scale groups, but we are looking for proposals that enable us to meet the adaptation and resilience needs of these groups at a significant scale. I hope that helps.
Yeah, thank you very much. The next question I have here is that availability of data is extremely crucial to build in bankability and attract private risk capital for adaptation projects. Given the data challenges in the sector, the agriculture food sector, how can this be addressed to successfully build models at scale? Okay, maybe Anil, you and Ajith, do you want to take that?
I think I would request Ajith to start off, because they have built a very nice framework, both the Maharashtra thing that we are fortunate to be associated with them, as well as the one that they are doing in, I think, Uttar Pradesh, if I'm right. So Ajith, after you. In fact, I had a small input on the first question as well, Namita, but
please go ahead. Why don't you? Okay, well, let Ajith answer and then you can add. Yeah.
Sure. So I would say, Namita, that the focus of the governments and also the civil society is now moving towards, and again, this ties with the earlier question around having a strong framework for mapping the outputs and also having a strong adaptation framework. Most of the governments are now looking at the possibility of integrating their actions in agriculture and water and also all the natural resource management sectors under the broad ambit of a data stack. And this is at least the case in India, where we see that in most cases that we have an intervention that would lead any government scheme or an activity to a marked or mapped outcome indicator towards that data stack. So in part, this is being kind of addressed. And I think where we are seeing some innovative changes again is in the process of, or in the application of spatial data. For example, even in the case of mapping the crop output from a certain region, now governments are increasingly preferring spatial outputs than going for manual crop cutting experiments. So this has shifted both the pace and also the quality and credibility of data that can now be used for financial modeling and also for designing appropriate financing products that can be used here. So that would be one. And the second and the last example that I have is mostly when it comes to system integration. I think Ravi did mention about systems reforms. So here the change or the trend that is also happening is there are more of service delivery models, which are largely, I think in agriculture, there is farming as a service, mechanization as a service, water irrigation as a service, these kind of models coming up. There are service providers who are also kind of working with financial institutions to offer these services to farmers, small and marginal farmers, where data is integrated or embedded into the service provision model. So in these two aspects, I think one at the systemic level where the governments are driving change, including spatial data along with the scheme data. And at the last mile or the last mile level, there's again the service providers who are also bringing a change in terms of incorporating data into services like micro irrigation, mechanization, and also decarbonization to a large extent.
Thank you.
Over to you, Anil.
I just want to add one dimension as a practitioner. Again, tagging of the asset is extremely important, and I'm really intrigued by the comment made by Kristina on green financing to financing the green. Just an interplay of words means so much of a meaning, between these two. Thanks, Kristina, for giving me that framework. So on financing green, how do you tag the assets? And our own journey into this, which is where I would like to link to the question from the microfinance institution, is first, you are in the business of lending and you are in the business of underwriting the transaction from a dimension of viability of that project to be able to generate the income and pay you back as a lender, right? And it has two dimensions. Dimension number one is how do you tag this so that you are indeed putting the source that you have got to fund such projects. If the source is it has to go for only green assets, how do I create an internal system to be able to tag that asset to that financing? And that's where working with specialized players who can build such capacity within the organization is an important dimension. A lender should always look at who can provide me those funnels so that you would be able to categorize the green assets under the categories that you can eventually go and get the money from. On the types of finance, in addition to what Ben mentioned as a response to the first question, I would also urge this microfinance institution to look for providing safety nets. Providing safety net has two connotations. One, safety net to them as the lender, right? What happens if you take aggressive positions on a pool of assets that qualify green financing? Second, safety net to the to the farmer or to the end user who has adopted that green financing technique. And that's where Dr. Dalia's point on adaptation, business case of an adaptation is too late already. How do you provide a safety net so that that transition becomes smoother, or you reduce the vulnerability of the adapter of the new technology? So our experience or our journey on the first dimension has been a guarantee program from USAID helped us a lot to understand this entire green space. That happened in 2017-18, around that period, and our own understanding of how we can take a little more aggressive calls on the entire pool, not being naive in giving money because there is a guarantee. It's like going and hitting your head on the wall because you have a helmet. You don't do that. You basically look at how do you take calls on borderline cases in a more constructive manner. because you have a safety net. You have a guarantee program that can, one, help you cross that line, and two, bring in the dimension of, going back to my original framework, the awareness of what qualifies and what does not qualify. Second, you also look at, are there safety nets for the farmers? And I think Ravi mentioned about the Andhra Pradesh government's initiative of Raitu Sadhikarika Samstha, the RYSS, where they have now proven a case of the individual farmer, the food forest model of 1 acre that they have has an economic benefit, and this is a time for them to scale. But that can happen if you provide a safety net that, should this does not succeed for whatever reason, is there the delta of difference that can be given, and that's where an insurance policy would be helpful. So in addition to the funding and wholesale, you also look at 2 instruments that can provide safety net. One is the guarantee, second one would be the insurance, is what I would say.
Thank you very much, Anil, for putting that out very articulately, and thanks, Ajith. I think we have very limited time now, and I just want to go to each of the speakers to just in a minute or less than a minute, 30 seconds maybe, just talk about, just like a rapid fire, I really want you to say one thing that you would do differently to accelerate capital to adaptation, especially the farm sector and communities. So I will go in the order of Alessandra, Ravi, Kristina, Ben, Ajith, Anil and Ajith. Over to you, Alessandra, just in 30 seconds, please.
All right, 30 seconds. There we go. I go back to my idea of policy-driven change. I really believe that what we need to do is to change the business model, if you wish, and change the set of incentives that different stakeholders have to invest. I think some colleagues before me spoke about the business case for adaptation, which, however, still relied on avoided costs in the future. What we do need to make, on the other hand, is a business case that relies on benefits and returns that are realized now, and we can do that through a sustainable finance frameworks and different tools addressing different aspects, whether it is disclosure or standards, and I think that is really the way forward. Thanks.
Okay, thank you, Ravi.
If there's one thing I could do, it would be to change perceptions of how we deal with services, both the ecosystem service, social services that are provided. All the models that we have.
Sorry, Ravi, we lost you. Can you hear Ravi? No.
I think he's frozen.
Maybe he dropped off. Yes, let's move on. Kristina, over to you. We'll get him back.
We need to think about that if adaptation is too.
Sorry, Ravi, we lost you for about 20 seconds. Can you just repeat the last part, please?
Yeah. I was speaking about the importance of creating approaches, a paradigm really within which the value of services is accounted for if we are going to get adaptation, because farmers produce much more but are not compensated for than the commodities that they are producing. And often extremely low value commodities like rice or wheat, where there is no hope that a farmer on 1 hectare or 2 hectare of land can ever get out of poverty, no matter what you do. So they need to be compensated for all the services, the ecosystem and social services they're providing. And that requires a systemic change in the way we deal with agriculture and land management.
Thank you. Kristina?
Yeah, so I think speaking about that systemic level of change and re-engineering the way things work, for me, the importance is to build out multi-stakeholder, but also multidisciplinary platforms where really we have representatives of each stakeholder group, from the private sector, from the people on the field level, from academia and science-based and civil society organizations to governments, and to find that winning model, because I think we do have these existing pillars now, but we really need to be practical and look beyond our realm and our responsibility and objectives and think more creatively to harness that real enabling environment that we need to create successful models, successful and practical models.
Yes. Yeah, I think I agree. Ben,
Yeah,
Your thoughts?
thanks. Yes, I'd like to just refer to one of the questions in the chat that hasn't been answered, which is saying what doesn't get monitored doesn't get done. And what we have in the mitigation space and climate change is a universal metric for measuring performance, greenhouse gas emissions. But what we don't have in the adaptation space is an agreed global metric for assessing performance in terms of resilience. This is a big gap. Now there are ways we can try and close it. We can use standards from different sectors for different products, but we need to really think about how we close that gap, how we agree on metrics in order to attract private sector investment into resilience funding. Thank you.
Thank you. Anil?
I would just say collaborate. If the 5-6 entities that you have brought in as part of this panel and the logos that you see on the screen of all of you, if all of us collaborate, successful models are not very far. We all have it, we all have the ingredients. We have to make it a recipe. That's it.
I agree. Ajith?
I would echo what Anil just mentioned, but I would also add, I guess, Namita, that in our quest to achieve excellence, we often kind of let go of what is practical. So I think what we need to do is to focus on implementable frameworks, and I'm talking specifically to the conditions that we are seeing here in India. While we all focus our efforts most on changing policies, this country has 1,000 or maybe 1 million policies that are not put to use. And what we need to have is one implementable framework which can bring all these partners and collaborators together and do what is ideal for the community.
Thank you. Thank you very much. I wish we had some more time to take these discussions into depth, but I think what we've really, in a sense, brought out is the fact that for bankable and viable projects, other than incentives, other than risk covers, we also need to build in a lot of awareness, collaboration. I think that is very important, and let perfect not be the enemy of good. There are so many good examples that are there, and how do we move them towards scalability? I think that is what is required. And then, one other point which was made very interestingly on the return on investment. Every 1 rupee invested in these kind of projects are bound to deliver multiplier kind of ROI, not just from a monetary standpoint, but also from an social impact standpoint. I think that's very important to look at. With that, we come to the close of the panel discussion, and thank you very much to all of you for joining us to this panel discussion. And Anil, yes, we will collaborate with everybody. Same my thoughts too, that we should get everybody together and look at how we can talk more about this. So thanks a lot, and over to you, Sudha, for taking this to the conclusion. Thank you.
Thanks, Namita. We are at the end of this really insightful webinar, and definitely echoing what Namita said and Mr. Anil said, we have to take this forward. I hope all of you benefited from listening to this, and it was very insightful for us. Special thanks to our partners for organizing this with us, and also a special mention to our colleague Surajit Iyer, who was the brains behind putting the whole webinar together. Thank you very much. Have a very good rest of the day. See you all.
Thank you. Bye-bye.
Thank you.
Thank you.
Thank
Bye.
you.
Thank you. Bye-bye.